What's up, everybody? It seems like all the buzz around the housing market today has to do with the recent dip in mortgage rates, giving buyers and some sellers hope of more inventory and a more affordable housing market. But is that all it is? Simply buzz? Will the Fed start to cut rates in 2024? And if they do, will home prices go up or will they go down? Today we'll take a look at an article by Robin Rothstein for Forbes titled, "Mortgage Rates Forecast for 2024. When Will Rates Finally Come Down?" A CNN article by Anna Bani titled, "Mortgage Rates Drop Under 7% for the First Time Since August." And Lance Lambert's article for Resi Club titled, "Goldman Sachs chief economist thinks housing affordability is so strained that existing home sales will remain suppressed through 2026. And we'll see what they all are saying. And as usual, I will chime in with my opinions as well. So let's dive right in. The 30-year fixed rate mortgage rate fell to an average of 6.95% for the week ending December 14th, down from 7.03% a week before, according to Freddie Mac data released last Thursday. A year ago, the average 30-year fixed rate was 6.31%. Market sentiment has significantly shifted over the last month, leading to a continued decline in mortgage rates, said Sam Qatar, Freddie Mac's chief economist. The current trajectory of rates is an encouraging development for potential homebuyers, he added, kickstarting a modest uptick in demand. They do put out a disclaimer that this average mortgage rate is based on mortgage applications that Freddie Mac receives from thousands of lenders across the country. The survey includes only borrowers that put 20% down and have excellent credit. A current buyer's rate may be different. Clearly, the lowering of interest rates will help fix the most unaffordable housing market since the 1980s, but will it be enough? Given inflation continues to decelerate and the Federal Reserve Board's current expectations that they will lower the federal funds target rate next year, we will likely see a gradual thawing of the housing market in the new year, Qatar said. Though Fed Chairman Jerome Powell reiterated in a press conference that inflation is still well above the Fed's long-term sustainable 2% target rates, policymakers released updated economic projections with a lower rate range in 2024 that included 3 cuts by year's end, implying that rate hikes are over for this cycle. So let's take a look at the average 30-year fixed rate mortgage rate predictions for 2024 from several industry experts. First, we have the National Association of Realtors. Chief economist Lawrence Yun said, mortgage rates look to head towards 7% in a few months and into the 6% range by the spring of 2024. According to Yun, 3 factors could influence the Fed's decision whether to cut rates. First, it's the job market, which has been softening each passing month. Jobs are being added, but you can see it's becoming lighter and lighter, and the Federal Reserve certainly does not want to see that number turn negative, Yun said. Second, the Fed may extend help to community banks, which have been suffering from high rates as their special credit line ends in March. Lastly, Yun expects that a slowdown in market rents should be a key driver of improvements in inflation. And Jessica Louts, Deputy Chief Economist and Vice President of Research at the National Association of Realtors, agrees with Yun, saying, "We do expect that mortgage rates will continue to tip down incrementally. By the spring of 2024, rates will be hopefully in the 6% range." Next, we have RSM US Real Estate Senior Analyst Crystal Sunbury, who said, assuming no significant economic shocks, mortgage rates are likely to continue slowly easing over the next few months to reach a 6% to 6.5% range by spring of 2024. And the Mortgage Bankers Association baseline forecast is for mortgage rates to end 2024 at 6.1% and reach 5.5% by the end of 2025 as Treasury rates decline and the spread narrows. Bank of America head of retail lending Matt Vernon believes mortgage rates will go down, but not until the end of 2024. The Fed's likely decision to cut rates in 2024 would be a key factor that could breathe new life into the housing market. However, it's important to note that significant drops in mortgage rates may not happen in the early months of 2024, If any reductions occur, they are likely to be gradual, possibly beginning in the latter part of the year. Palisades Group Chief Investment Officer and co-founder Jack McDowell agrees with Vernon. Our best guess is that mortgage rates will remain in the 7 to 7.25 range throughout Q1 of 2024. This view is based on the idea that inflation is trending positively toward the 2% targets, and the Federal Reserve is likely done raising interest rates in 2023. Daniel Hale, Realtor.com's chief economist, sees rates dropping to the mid-sixes by the end of 2024. We expect the decline to move into 2024 and see mortgage rates at about 6.5% at the end of 2024, and to average around 6.8% for the calendar year, Hale said. Redfin predicts that rates will hover around 7% in the first quarter before gradually dropping to 6.6% by the end of 2024, with the Fed cutting rates 2 or 3 times starting in the summer. Mortgage rates are likely to remain well above pandemic-era record lows because financial markets increasingly believe the country will avoid a recession in 2024, Redfin analysts wrote. But in order for the housing market to be more affordable, we don't only need lower mortgage rates, we also need more inventory, so buyers aren't competing over the same house, driving the prices higher. The disparity between today's higher market mortgage rates and the lower rates that existing homeowners benefit from on their current mortgages, commonly referred to as the lock-in effect, is expected to play a role in maintaining low inventory levels, said J.E. Shu, an economist at Realtor.com. As home shoppers compete over the still limited inventory, prices are expected to stay elevated, maintaining affordability as a top concern. Nearly 2/3 of mortgage rate holders have an interest rate of 4% or lower, and nearly 90% of mortgage rate holders have an interest rate of 6% or lower, according to ICE Mortgage Technology, a mortgage data company. That means that even if rates do come down to a mid-6% level, motivating those homeowners to sell with an ultra-low mortgage rate is still going to be challenging. We often talk about how lower mortgage rates will bring more buyers into the market, said Lisa Sturdivant, Bright MLS's chief economist. But in this very unusual market, where inventory has been locked down, it is more important to watch how falling rates influence prospective sellers' decisions. And I agree that without more sellers putting their homes on the market, prices will most likely stay high, keeping the housing market unaffordable for most buyers. In Lambert's article, he reports that Goldman Sachs' forecast model anticipates that strained housing affordability, which has hindered many sellers and buyers, will keep U.S. existing home sales suppressed for the next several years. The projections estimate sales at 3.83 million in 2024, 4.24 million in 2025, and 4.37 million in 2026. Goldman Sachs does not expect a meaningful recovery until 2027, when it anticipates U.S. existing home sales to reach 5 million. This figure would still fall below pre-pandemic levels in 2019, 5.34 million, and considerably lower than the pandemic housing boom frenzy in 2021, 6.12 million. Among forecasters, Goldman Sachs' existing home sales predictions is on the bearish side. This is not good news for buyers who are hoping prices will come down with the lowering of mortgage rates, inspiring homeowners to put their homes on the market, thus creating more inventory. Goldman Sachs' chief economist put its home price forecast out last Monday, which has U.S. home prices rising 0.6% in 2024, 3.8% in 2025, 4.9% in 2026, and 4.9% in 2027. When rates come down, we're going to be in store for another hot housing market where there are more buyers than sellers jacking up prices because we haven't solved the problem of low inventory, says Daryl Fairweather, chief economist at Redfin. It's still that affordability problem that's going to stay with us. So let's take a look at Redfin's latest housing market update to see the current data on the housing market for the 4 weeks ending December 10th. The daily average 30-year fixed mortgage rate was 6.82% on December 13th. the lowest level since May, and up from 6.39% a year ago. The source is Mortgage News Daily. The median sale price is up 4.5% year over year, the biggest increase since October of 2022. The median asking price is up 5.7% year over year. The metro with the biggest increase in median sale price is Anaheim, California, up 19.2% year over year, with Fort Lauderdale, Florida coming in second, up 14.9% year over year. The metro with the biggest decrease in median sales price is Austin, Texas, down 5.3% year over year, with San Antonio, Texas coming in second, down 3.3% year over year. New listings are up 7.6% year over year, the biggest uptick since July of 2021. The increase is partly because new listings were falling this time last year, and active listings are down 5.4% year over year, the smallest decline since June. The metro with the largest increase in new listings is Phoenix, Arizona, up 24.4% year over year, with Orlando, Florida coming in second, up 21.1% year over year. The metro with the biggest decrease in new listings is San Francisco, California, down 23.7% year over year, with Atlanta coming in second, down 14.5% year over year. The median days on the market is 36 days, down from 39 days a year ago. 26.2% of the homes are still selling above the list price, up from 24% a year ago. And 5.3% of homes for sale each week did have a price drop, up 0.4 points from a year ago. So to wrap it up, most of the industry experts do expect mortgage rates to come down next year, but that doesn't necessarily mean the housing market will become more affordable unless prices come down too. And as we know, real estate is very localized, so what's happening in one part of our country can be very different than what's happening in another part. The National Association of Realtors identified 10 real estate markets with the most pent-up housing demand, which it expects to outperform all other metros in 2024. In order, the markets are as follows. Number 1, Austin, Round Rock, Georgetown, Texas. 2, Dallas, Fort Worth, Arlington, Texas. 3, Dayton, Kettering, Ohio. 4, Durham, Chapel Hill, North Carolina. 5, Harrisburg, Carlisle, Pennsylvania. 6, Houston, The Woodlands, Sugar Land, Texas. 7, Nashville, Davidson, Murfreesboro, Franklin, Tennessee. 8, Philadelphia, Camden, Wilmington, Pennsylvania, New Jersey, Delaware, Maryland. 9, Portland, South Portland, Maine. And 10, the Washington, Arlington, Alexandria, DC, Virginia, Maryland, West Virginia. To be honest, that sounds like a lot more than 10 real estate markets, but that's their list. So what are you seeing where you live? Are you seeing more inventory? Definitely comment below and tell us where you're from and what you're seeing. It is the best way we can all really see what's happening in our housing markets. I can tell you that here in the DC area, we are still seeing multiple offers on good houses, those houses that are priced right and show well, with the prices going way above the asking price, while other houses are sitting on the market with price reductions week after week. It is literally house by house. If you missed last week's video on Redfin's housing market predictions for 2024, definitely check that out next. Thanks for watching. I do appreciate it. Bye!